On YouTube, Jay Diggs, your investment guy, back with another video. So I've been getting a lot of questions from people that checked out the channel that don't really understand the stock market. They don't know how to invest, what to look at. They don't even know how the stock market operates. So this video today is strictly for beginners. I'm going to be talking about the questions I get asked. I'm going to break it down. I'm going to put a lot of things in the descriptions, a lot of videos, a lot of links, so please check them out. So I'm strictly going to do stocks today. I'm not going to talk about bonds, securities, futures. I'm just going to strictly talk about the stock market. Just stocks. So the number one question I get asked is, can you lose money in the stock market? And I'm like, of course you can. There's only one way to lose money in the stock market, but the way you lose money in the stock market is the same way you lose money in any other industry. If you buy high and sell low. If you go to the dealership today and buy a brand new Mustang for $50,000 and the very next week you sell it for $40,000, guess what? You just lost money. So it's just like that in the stock market. If you buy high and sell low, you are going to lose money. Point blank. Number two question I get asked is, what if the stock market crashes? What if it just obliterates? What you should do is absolutely subscribe to this channel so you don't lose your money in the stock market. So when the stock market goes down, you stay afloat. So go ahead, hit the subscribe button so you can stay in tune and know what's going on. So to get back to that question, the only time the stock market has ever gone down and crashed and been just crazy down was in the Great Depression. You all know that, 1929. But even when the stock market fell in 1929, it fell by 25%. So in my logic, the way I'm thinking, I know it's a little more complicated with what you invest in, this, that, and the third, but if you have $100 and somebody says, look, the worst case scenario that's ever happened in the past is you're going to lose 25% of that $100. That's 25 bucks. You're at 75. If you make smart decisions and you invest wisely, I'm sure during any downturn in the stock market, you will have success. You will be able to pick up more assets for lower, and you will be able to make it through until the stock market goes back up. So let's look at the different types of stocks. You have common stocks, you have preferred stocks. Common stocks represents the ownership in a company and a claim on a portion of the company's net profits. Common stockholders can also vote to elect the board of directors. Historically, common stocks has held higher returns than most other investments. In addition to higher returns, common stocks also carries a significant risk. If a company does go bankrupt, the common stockholders will not receive money until the creditors, board holders, and preferred stockholders are paid. This risk can be reduced by owning a variety of well-established stocks that have solid financial statements and a history of strong earnings. Preferred stocks represent some degree of ownership in a company, but usually does not come with the same voting rights. With preferred shares, investors are usually guaranteed a fixed dividend. Unlike common stocks, preferred stocks doesn't usually provide the same appreciation in the stock market, which results in a lower overall risk and return. One advantage of a preferred stock is in the event of bankruptcy, preferred shareholders are paid off before common shareholders. After you have your common stocks and preferred stocks, then they break down the different classifications: growth stocks, value stocks, and income stocks. Income stocks typically pay a regular quarterly dividend to shareholders. These are usually high-quality, well-established companies with a history of strong profits and steady dividend increase. Value stocks usually have one or more of the following characteristics: low price to earnings ratio, low price to book ratio, low price to dividend ratio. In other words, these stocks are underpriced when compared to other similar companies in the stock market. Sometimes this is a result of financial distress or management problems. Other times it may be due to investor settlement and cyclical trends. Then we have growth stocks. Growth stocks are stocks of companies with profits that are increasing quickly. This increase in profits is accompanied by a rise in the company's stock price. These companies often reinvest the profits and pay little to no dividend to their stock owners. In doing so, they hope that the growth in the stock price is enough to keep shareholders aboard. So now that we looked at the different characteristics, how stocks break down, your income stocks and things like that, let's look at the different sectors within the stock market. You have energy, basic material, industrial, consumer discretionary, consumer staple, healthcare, financial, information technology, communication, utilities, and real estate. Those are the different sectors within the stock market. Let's look at energy. The energy sector contains oil, gas, coal, and fuel companies, as well as energy equipment and services. You can think of the equipment and services as the companies that build oil drilling equipment, and the services as companies that oil companies hire. Your major players in this sector are Exxon, Shell, Chevron, BP. Now let's take a look at basic material. The basic material sector are chemical, construction material, packaging, metals, and paper companies. These companies are usually operating in the business-to-business space, meaning that they sell their products to other companies. They provide the key supplies that are put into the products that you and I purchase. You can think of these companies as being at the beginning of the supply chain. They provide steel for cars, the wood for homes, the plastic for packaging, and more. Well-known companies in the material sectors are DuPont, Scotts Miracle-Gro, and Sherwin-Williams. Let's look at industrial. The defense machinery, aerospace, airlines, construction, and manufacturing companies are in this sector. There are a lot of large cap companies in this sector. They include Boeing, 3M, Honeywell, UPS, Delta, Lockheed Martin, Caterpillar, and many more. Now let's look at consumer discretionary. The fourth sector on this list is consumer discretionary. These are companies where you and I spend a lot of our money. It's where our discretionary items come from. It's the retailers, apparel, restaurants, auto, hotel, media, and household products. You've heard of these companies in this sector before. You got Amazon, Home Depot, Ford, Starbucks, Target, Chipotle, and many, many more. Along with consumer discretionary, there are also consumer staples. These are the food, beverages, and tobacco companies. They're also manufacturers of household goods and personal products, as well as supermarkets. You've likely heard of these companies like Coca-Cola, Walmart, Procter & Gamble, Costco, Kraft Heinz, and many more. These are considered a defense sector because these companies are generally resilient in the event of an economic downturn. Now let's look at healthcare. Companies in the healthcare sector are the pharmaceutical, healthcare equipment, and healthcare services. For example, Johnson & Johnson and United Healthcare. The companies in this sector are often good plays and safe bets because people will always need medical care, whether it's from pharmaceutical drugs or hospital visits. Now let's look at the financial sector. The financial sector consists of banks, insurance, and real estate companies. This sector is closely tied with interest rates. If interest rates increase, the big banks make billions of dollars more. This is because banks give out loans and mortgages, and the higher interest rates all go to the bank. Companies in this sector: J.P. Morgan, Bank of America, Wells Fargo, U.S. Bank, Goldman Sachs. The next sector we have is information technology, commonly referred to as the tech sector. Companies in this sector include internet software, semiconductor companies. It also includes manufacturing of electronic equipment, data processing, and communication equipment, and IT services. Companies in this sector: Microsoft, Intel, Visa, MasterCard, Adobe, Salesforce, and Square. Now let's look at the communication sector. Companies in this sector you know very well: Verizon, AT&T, T-Mobile, Sprint, Comcast, Netflix, Facebook, and Google. Now let's look at the utility sector. These companies are electric companies, gas, and water utilities. Since these companies operate in a regional area, you would likely only recognize your local utility. Some of those utilities include Duke, Dominion, PG&E, companies of that nature. The last sector in the stock market is real estate. This one's pretty self-explanatory. It includes real estate developers and REITs. REITs, which are real estate investment trusts. So this sector takes care of malls, offices, senior living, apartments, things of that nature. Now that we have the breakdown of the different sectors within the breakdown of stocks, now let's go over some terminology that may help you out, that should help you out. No matter if you're investing on M1 Finance, Robinhood, Fidelity, Charles Schwab, whatever institution you're investing with, these terms will help. And I'm gonna open up my Dominion so you can take a look at the terms that I'm really talking about. So taking a look at my Dominion, if you look on the down under statistics, you'll see volume, average volume, market cap, P ratio, dividend / yield. The volume is commonly reported as the number of shares that change hands during a given day. The average volume of a share or security over a longer period of time is the total amount traded in that period. Market capitalization, or market cap, refers to the total value of a company's shares of stock. As a result, investments in large cap stocks may be considered more conservative than the investment in small cap or mid cap stocks. Price to earning ratio is the ratio for valuing a company that measures its current share price relative to its share price earnings. PE ratios are used by investors and analysts to determine the relative value of a company's share in an apples-to-apples comparison. The dividend yield or dividend price ratio of a share is the dividend per share divided by the price per share. You can also divide the annual dividend by the market cap to get the dividend yield ratio. Guys, I hope this video helped. If it did, please hit the like button. If you haven't subscribed already, please smash that subscribe button so you can stay informed, so you can stay in tune. And I'll see you guys on the next one. Happy trading. Peace.